Okay, my name is Julio Cesar Hidrobo, Colombian. I'm here because I want to just to get into this network. This is my first time here. I'm an agent, investor. I have a license in Maryland, in DC, and in Virginia. I have a listing today in the market already. But I'm ready to invest, basically. So I have some money to invest. I'm ready to explore different opportunities. That's what I'm here, basically. Yeah, to hear and to do something with a group. That's what I want to do.
And that's what the group is here for.
Yes.
So we're glad to have you.
Yes.
Get some business done. Mr. Connor, say what's up.
All right, guys, I'm Connor. I'm with Washington Capital Partners. We are a hard money lender out of the Mid-Atlantic. We lend anywhere from Florida, Texas, Carolinas, up to Jersey and Pennsylvania. Our team helps to run the Falls Church grid along with the Philadelphia grid as well. We finance anything from one-bedroom condos that are $75K up to large multifamily buildings for $15 million. Doing anything from 12, 24-month loans for acquisition and construction to 30-year financing as well, so we can hold everything in-house. On top of that, we also partner with a lot of wholesalers. We have a sister site called Off Market Deals HQ, where we are putting together all of the off-market opportunities that we can find in the markets that we're in, and putting that out to all of our clients, because at the end of the day, we can't do anything as a lender if there's no properties to lend on. So that's what we do. So we're putting about 60 to 70 of those deals out a month.
So if you don't already have Connor's information about that website, get it, so that you can be getting those emails, because I've seen stuff on there, like, oh, that's pretty good. Let me make a call about that, and I go somewhere else and call back, and then someone else makes 6 figures on one of your deals. So they come across some really good stuff. So somebody worth knowing on a number of levels. Good to see you. We'll be talking to you in a moment.
Absolutely.
Yes, hello.
I'm Justin Shutters. I'm a commercial lender with Bank of Clark County. Work here, well, not here, but out of our office in Tyson's Corner. In case folks don't know, Clark County is the county beside Loudoun. So bank has been around since 1881 and will lend to anything that's in an LLC, including residential properties. And we do finance 100% for experienced flippers.
Awesome. Very good.
Good to have more money. Can't have too much money. What's on you, money?
I do, but he said experienced investor. That just
Always say
really
you're
bad.
experienced.
No, but I'm sorry.
That's all right. Tell us what you're looking for.
I'm an agent. I'm licensed in Virginia and Maryland, and me and my husband owns an appliance repair business. We do household appliances, big appliances, and we do HVAC, heating and cooling, and water heater. So if any of you are doing your flipping, if you guys need any of that help, I'm your girl.
Yeah, and they do it very well, very well.
Thank
And you are very well educated in real estate investing, so you are now experienced.
Okay.
You just tell everybody.
Hello, I'm Sabina. I'm also a real estate agent in Virginia, Maryland, and DC. I also invest in residential and multifamily. And I'm here to network and find my way too.
Awesome. And if you could do me a further favor, Sabina, your girlfriend would have really appreciated it if you snapped a photo or two and sent them Jess's way. She would just faint and fall on the floor and roll around. She'd be so happy and stunned that we actually took a couple of photos for us people hanging out in the room. I would really appreciate it. Hello.
Hi, I'm Judy. It's my first time here. I've got 2 doors and I'm just looking to kind of ramp up that. So I'm doing a house hack right now and will be interested in selling appliances. I am looking for another rental this year. Had talked to Mike Weber, but I don't see him here today.
He's got COVID, unfortunately.
Oh,
And
okay.
he's probably trying to get on Zoom once we figure out how to get on Zoom.
Zoom schmoom.
I am looking for a DSCR loan, and my next property to buy and hold.
Awesome.
Excellent. Michelle, what's a DSCR loan?
I have no idea.
Oh,
That was the part of the test. I was like, the money part was where I got lost.
That's on me then. Well, go ahead, say it.
No, it's probably in there.
No, I bet it's not.
Graham, back me up. I told Graham the hardest part was going to be when it got to the money part, because that's when I got overwhelmed in the class. My name's Michelle Hudon. I'm an agent out of this office. So this is a second career for me. So looking to do investments myself, so newer. And here to network too. And build a team, find the money. I need a contractor.
Do all the things.
Yeah.
Do all of it. Cool.
Hi, Graham Tracy, also an agent here in Reston office. Looking to get started in investing, I'd say, and also just better service and investor clients of mine too.
Excellent. All right, before I forget though, quick show of hands for someone who doesn't work in lending. DSCR?
Debt service coverage ratio.
Yes, sir. Thank you very much. I'm sure you already knew because you're looking for it.
Photographic memory.
Baby.
Debt service coverage ratio, loan based on the productivity of the asset, not so much the lendability of the applicant, right? Yes, sir. Hello.
I need one
Hey
of those.
everybody, my
That's what I
name
need.
is Jesus, and I'm also an agent here in Virginia, licensed in Florida too. This is my first time coming here, and we got our first property flip, ended up not turning into a flip, but anyways, long story short, we do have property in Florida. I'm looking to find out more about, you know, lending when you do find a deal, where to go for money and stuff like that. Ideally, I'd like to do more in Florida, but I'm open to doing stuff here too.
What part of Florida?
Fort Lauderdale.
Not too shabby. I think we may be having great things happening in Fort Lauderdale. I think we know people have money in Fort Lauderdale.
Mm-hmm.
Yeah, all right,
Yeah.
good. We've got Fort Lauderdale connections. Cool. Well, welcome. Good to see you.
I don't know
Hello.
Fort Lauderdale. I have
You
a
want to
property
move it
there, and yeah, I have a property there. It has, it's a 3-unit property, and our insurance just dumped us, like,
That's a big
and,
problem over there, right?
yeah, so, and we just redid the home inspection, and like, everything is going up there. This is not the first time we've been dumped by our insurance in the last, I think, 3 years. This is our 3rd one, if I remember correctly.
Homeowners, landlord, what kind of insurance was it?
For the whole property, the homeowners.
Your homeowner's insurance?
Yeah, cause, so the main house, my mom stays in there, and then the other 2 rentals pays for the mortgage and all of the utilities. So she just stays there to make sure that everything's okay. But, I don't know, I would not personally, I'm like staying clear from Florida, but. I'm Joanne, I gave you my
And
2
things
cents
are
about
slow
permission.
going, things
but-
are slow going construction wise, but you know.
Yeah,
And what was the rationale for the insurance?
I still don't know.
There's
I
a
still-
large, so in the insurance secondary market, there's a large, pretty much a re-underwrite of all Florida insurance
Mhm.
policies, and that's why that's a lot of the time is occurring. So when we're actually lending on Florida properties currently,
Mhm.
if there is a storm coming in, they will not bond anything at
Wow.
all. So that is an issue.
It's Florida, there's always a storm.
I know.
Exactly.
So how many lending days do you get out of
So you're
each?
saying the winter months are the only months we can buy
We've
that?
had,
You can
we've had
buy-
to delay closings. We've had to delay closings because insurance companies would not bond anything. So it really is a timing purpose of things, but I think it's, I don't wanna say it's Fidelity, but one of the major insurance providers is going through a huge re-underwrite of what's gonna be allowable in Florida.
Yeah,
So
it's-
that's occurring.
That's been a mess, and we went through, my brother, he has, an insurance company, so he uses other companies.
That's exactly, yep.
And we just, I'm just like, I'm done with that property. If it wasn't, profitable to keep it, I would just dump it in a heartbeat, just be out of Florida. But my name's Joanne. I am a physician assistant. I've owned several, single property, homes, rented. I'm no longer interested in doing that, looking for, commercial properties, quads, apartments. That's what I'm interested in. So here, looking to make friends, people, I'm gonna talk to you, it's up to you. Just meet people, network, and just, learn, because obviously I do not know a lot of things. This has been a humbling experience, and I've been kicked around for the last month, where I've lost several deals for not being prepared. So I'm here to learn, so the next deal I find, I can actually buy it.
Awesome. Well, let's do that. Good to see you.
Hey, I'm Yumi. I came back, this is my second time. I'm also a realtor in the area. I'm new to real estate investing, and I'm hoping to get a rental property by the end of this year. So, yes, you know, learn and network.
Welcome back, good to see you. I'm sorry, you would be?
I'm Elizabeth Anderson, and I worked for an investor for 4.5 years, and I want to get into wholesale myself. So I know how to talk to people, I know how to find the deals, I know how to, convince people to sign the contracts and all that stuff, but I need help networking, getting into the other stuff.
Right. So that's a longtime friend of the CAZA companies and Grid. Yeah, you need somebody who knows how to talk to people. Lisa Mack can talk to the information out of anybody. Better than anybody. Awesome. Well, thank you very much. Say hello. Oh, and by the way, if you get any texts that say I'm here, that's somebody downstairs. So just be on the lookout. Say hello.
Hi, I'm Skylar. I'm an agent with the CAZA Group. I also work directly with Mark and help him with all the little things he needs. But yeah, I don't know how to sum that up.
Yeah, soon all of it.
I'm gonna run it.
You need construction services, talk to Skylar. Skylar will run CAZA Construction and take it to phenomenal new heights instead of mine, stupid behind. So, Skylar might also snap a photo or two.
Yeah, I'm not just being really creepy in the back. It's like there's a purpose for it, I
For a
promise.
fun social, so we can socialize and let people know what's happening. Speaking of socializing, that all again was not a lost exercise, right? We do all that so that everybody can understand. We've got people in the room that have deals and have money and have skills and have really cool things they'd like to talk to you about. So we'll chat about our bit here, and then we're going to hang out for a little bit if you want, and we can talk about business, we can talk about deals, you can talk about money, you can meet everybody else in here, right? And those of you who know that when you get that information, we don't just kind of file it away, right? We get that information and then we follow up, right? That's where you're really gonna make your money. Get information and then just chat one another up offline. You don't wanna chat to anybody else, take me out for coffee. I'm really long-winded, the hour will pass quickly. But seriously, check in with everybody, check in with one another. That's where the deals get made, the money.
Fortune is in the follow-up.
Fortune is in the follow-up. The fortunes are not in the room, so the important legal stuff is this is all just lies and just gobbledygook. Hello. Welcome. Come on in. Ignore all of the beeping. We'll have that covered in tape soon enough. But actually, it's probably all fairly legitimate information, but please vet it for yourself, right? Not accountants, not attorneys, not mortgage makers and whatnot. Just if you meet anybody, you do anything, vet them. Understand what you're doing, right? Because otherwise, you talk about what works for us. All right, so the topic for this evening then is chatting about money. What's going to be the most comfortable thing for you, Connor? I don't want to lean heavily on you. You want to hang out, you want to be comfortable in your chair, I can ask you stuff, you want to hang out up here, because he's got several million more dollars than I do. You can help us chat about hard money.
So, hard money or full finance different ways?
Well, so you're a hard money lender, right?
Yes, sir.
And you're a hard money lender because, as we all know, it is really hard to get money for deals, right?
Sometimes.
Is that the
I
deal?
don't feel that way, but yes. There's always other people's money out there, it just depends on how you want to finance that deal. You can go the traditional route, looking for a 203K loan. That's gonna be a longer process. You'll probably have a good 2 or 3K loan. There's gonna be a little bit more red tape for that, but you can have a lower interest rate. With a hard money lender, you're looking for a quick close. Because of that quick close and less red tape, a faster process, you're gonna pay a little bit higher interest rate and higher fees. If you don't mind me asking, what's your origination? As a bank, so.
Yeah, depends on several factors, but I mean, a lot of times we'll do it at 0.5%. Not for that, product I was discussing about 100%, but, you're buying multifamily.
You're putting
apartment
money into
building.
it.
Yeah, I mean, not including the actual interest rate, you're looking at maybe 0.5%.
Use that as an example because as a hard money lender, my minimum is 2. So there you can see you're already paying a little bit more upfront. The difference is likely going to be speed. Interest rate wise, on the hard money bridge side, right now, unfortunately, our lowest is 9%. 2 weeks ago, it was 7.
Explain bridge. What do you mean by bridge?
So when I say
Explain 2 or 3K loan. We don't.
Okay, I'll go there. So, when I say bridge, I mean a short-term loan, 12, 24 months. And when I say term, I mean anything that's 30, 15-year loans. So really, you're gonna be utilizing that bridge loan for acquisition and construction. When you guys come and you do the buy BRRRR strategy with Mark, that is the beginning of that. That is the beginning of buying it, rehabbing it, rent it, refi. WCP can do all of those things in-house. We have both of those loans available. So bridge is the beginning, term is really the stabilized, you're keeping that for your rental.
Cool. And we'll keep talking about terms and things and costs and that stuff. But we started with hard money, and we'll keep referring it to hard money, but there's literally nothing really difficult about it, right? You exist to make loans. Hard is not a description of difficulty, right? Hard is just an old banking term, it's based on hard assets. It's just silly. Private money is what I oftentimes refer to it as.
It's very close to that. There's actually a big push in the industry to change it from hard money to asset-based. I think that's what the term that they're looking for. For me, as a hard money lender, there is a difference between a hard money lending company and a private lender. Generally, private lenders are going to be individual, which I believe we have someone on Zoom tonight that may be speaking.
We don't have Zoom tonight, we don't have Zoom.
Okay, so private
You can
lender,
say anything you want.
private lender is going to be an individual. I like to call him Uncle Tony in the basement with a couple $1 million that you can go to and say, hey, I need $400,000 for this house. If they like you and they like the numbers of the deal, they're going to give it to you. But that rate's going to be likely even higher than mine, probably 15 to 20%, 100% financing, good fees. However, with private lenders, the one thing you need to look for is what is their foreclosure rate on that, because a lot of private lenders, that is how they protect themselves. If you miss a payment, if you're not hitting a draw schedule, they're going to look to take that property back because they have a lot of risk against it. As a hard money lender myself, I don't want to take anything back because I don't have a construction company. So it's in my best interest to make sure that your best interests are aligned to make sure you're going through things. Now, from the hard money lending side of structuring the finance, we're typically going to be looking anywhere from 10 to 20% down of what's called the total project cost. In this case,
And tell you what, and not to slow you roll, but I think we'll probably get to that.
oh, okay.
Some stuff we can even kind of make reference to. So Ali, before we get too much further down the road, you want to talk about 203K?
Yeah, so 203K loan is typically a loan where you're buying the property and you can finance the renovation into the mortgage, right? So you kind of have a draw schedule, you decide with the contractor, decide what the renovations are, get that approved through the lender, and after you purchase the property, you're able to draw against that and make the renovations. A lot of traditional lenders are able to do that type of loan. Typically the property, it has to be in a livable condition. You can't buy something with a hole on the roof typically. In previous, before the market turned in 2018, like for real estate agents out there, I knew an agent that was very successful at what she did, and she specialized in a small area, and she would find properties that are not so appealing for her clients with a contractor that already would come in and draw the vision with an architect already teamed up with them. And she was selling properties like that by saying, hey, you can buy this $800,000 home, you have a $200,000 renovation in addition, everything, you turn it into the vision that you have for this other property that's down the street. And instead of competing out there on the market, she was just getting a lot of business helping people buy properties that nobody else was. So this is actually a solution, not just for consumers, but also for agents to be creative with.
Okay, and then, correct me, maybe 203K, is that owner occupied? Can you do 203K, do you know, non-owner occupied?
I believe so.
You guys do 203Ks?
I mean, yeah, we just typically look at it, one of three ways, owner occupied, non-owner occupied, and that's typically for actual commercial buildings or multifamily. And then, there's another division that we have to classify with the FDIC when we're looking at our books, investment real estate. So, I mean, it's still classified as commercial loan, it has to be held in a corporation.
But that's not a 203K.
No.
203K specifically, the 203K program, I believe is specifically for owner-occupied property.
Yeah, I mean, we have people on the residential side, if it's held in their personal name.
Do a house
It's the
hack.
same as like renovation loan.
Correct.
Yeah, yeah.
Okay,
It's
so,
like a
okay.
It's called it's the full name, 203K renovation.
Okay,
loan.
that's, okay.
It would be, it's good for a house hack.
Yeah.
Okay.
Yeah.
Because I'm 99% certain, but somebody look it up on the internet real quick, that that is for owner occupied property, because the point is, that rolls into a regular mortgage.
Right, you have to make all the decision before you purchase. right?
Correct.
Before you go on settlement.
Correct.
You
They
have
want to
to
know
get-
ahead of time what you're gonna do.
Right, okay.
And you have a limited amount of time to do it, but then after that, it rolls into a traditional mortgage. You lending to owner occupied properties?
Nothing I do is owner occupied. Everything that we do is investment purposes.
Big difference, right?
So 2 or 3 K's out.
2 or
House
3,
hack.
2 or 3K is a cool program, and the rates are relatively low compared to other things, but it's for owner occupied property.
Yeah, my suggestion on the 2 or 3K loan is, if you're going with that, go with a lender that has a lot of experience doing that. Go with a contractor that has a lot of experience doing that, otherwise it'll be a mess.
You actually have to go with a lender, a contractor that is 2 or 3K approved.
Because I did it
Right.
3K 2 years ago, a
Mhm.
property in Ashford.
Mhm.
So we had to go with everybody that the lender wanted,
Correct.
us to. And then we had to give an estimate before settlement
Yep.
and all that, so.
Yeah, so
Does it work out
more
that way
basic.
when they're telling you exactly who to use, or did you find
Yeah, I
it
mean,
to
they
be
have to be
difficult?
licensed and certified, so even to the tile, like which tile they're gonna buy, how much per tile, like it was just a lot of work.
Yeah.
Too,
It's-
because I don't know those people, and it was all, the lender just gave you a list of contract to call
Mhm.
and estimates, and they had their own people for the kitchen, for the cabinets and all that stuff.
So the bank doesn't usually limit you, they'll give you suggestions,
Yeah, they,
right?
yeah.
So it helps to go with somebody, like they have to be licensed, but they also have experience working, doing 2 or 3K loans. There's a lot of paperwork involved, and if they don't get it right, they'll delaying things, right?
Yeah.
There's, so they have to provide you with at least 3 options. And there's actually 2 different 2 or 3K loans. One I believe is for 50K and under, and then one is 50 to 80, and they just allow for different options with their 50K construction budget, sorry. Allow for different options there. So really, this is house hack to rental type of situation, not a fix and flip as an investment.
Yep. And then we've got up here on the screen a couple other ways that you can finance your fix and flip, buy and hold kind of properties. Cash, obviously, you get cash, you can buy things with cash. I don't know too many people who do any kind of real estate investing at any kind of level who do things in cash, even though they might have it, for reasons that we'll get into. Really more
I have
about
a
return.
listing right now, and the ones that sells, they're flippers, and maybe they're on my Facebook Live, and they got cash, like, a good amount of cash in this deal. So they should be listening to our class.
You certainly can. I mean, that's the easiest thing to do, right? You've got the money, stroke a check, buy your house, and go renovate it. But there are advantages to using other people's money too, that we will get into, but most important of which is leverage, which we'll explain. So you've only got other things you can kind of use to fund stuff, right? You've got home equity and stocks and other stuff that obviously if you want to sell it, you can sell it to generate money to buy your deal. If you weren't aware of it, your IRA in a correct type of account can be used to purchase real estate. It's called self-directed IRA, if you're not familiar with that. Come next month, month after, we talk about alternative ways to fund stuff, including self-directed IRAs. It's a great discussion. It's a really powerful way to build a lot of tax-reduced or tax-free wealth for retirement in your retirement account. So we highly suggest it, but it's a different kind of discussion. And then, of course, your friends, families, partners, right? You can bring in other people to get your deal done. We've done that. We did that a number of years ago where I've got a deal, we know how to get it done, know how to fix it, but hey, guy, you give me the money and we'll split it. We'll find a way to do it. Rich guy, give you the money, we'll go and do all the legwork, get stuff done, and we'll give you a piece of the deal. Fine, works perfectly well. Works really well for some people. A lot of people do most of their business that way. But we will get into how some of the numbers work where there may be a different and better way for you to get a thing funded rather than giving half or more of it to someone else just for the sake of providing the funds. Half of the profit on a profitable deal can be kind of expensive. You'd think loans are expensive, try giving away half of your deal. So we'll maybe see how some of the numbers kind of shake out on that, but and friends, families, and partners, and joint ventures, and those things are all great. But the more of it that you can keep for yourself, usually the better off you are. So using less expensive leverage is a good way to do that. And then, of course, then the last one is obviously loans, and where we've talked about a few different kinds of loans, and we continue talking about more. So loan sources, right? So we talked about a couple of ways you can get loans from a traditional bank. The 203K is probably the one that is the most apt for this kind of thing that we're talking about, because it is meant for doing construction, but it is, I believe, only for owner occupied. There are some hoops, they tell you kind of what they want you to do. A lot of forms, a lot of waiting, that kind of thing. Not necessarily super effective for a rehab deal. I don't think I've ever seen anybody use one for someone that was what we would call the typical motivated seller. I'm gonna buy your house as is, I'm gonna buy it in a couple of weeks, we'll get this thing behind you, you can move on with your life, all the things we wanna tell our sellers that allow us to get deals at the prices that we do. Oh, by the way, I'm gonna fill out a loan with the app with the 203K guy, and they'll need like 5 guys to come out and appraise it and give me estimates and do other stuff. We'll probably be able to get this done around fall. Will that work for you? Not really a good conversation to have typically with your typical motivated seller. That is typically who we're dealing with, or we want to be dealing with, when we're buying our deals, right? Same thing with a traditional good old-fashioned loan, like the good old-fashioned 30-year mortgagee kind of loan. Even if you were going to live in it, by the way, if you have no intention to live in it, you probably shouldn't tell the bank I want a good old-fashioned traditional 30-year homeowner loan. That's fraud, so maybe don't do that. But there are programs out there for investors, right, that can still have those longer amortization terms, amortization being the number of years that you can roll that loan out for. But those are different specific programs, and again, not the traditional Fannie, Freddie, 30-year stuff that you're used to. You just go on to Zillow and say, what's the cheapest loan I can get? That's the traditional kind of Fannie, Freddie back 30-year mortgage stuff. You can do it. It's, again, going to be a little bit of a longer process. Most people here have probably had some interaction with the mortgage loan process. At the fastest, I don't know, how long does it take to close a loan these days?
It's 3 weeks.
21-ish days.
8 days.
Everything breaks your way, goes
You
as
can push it
fast as
faster.
you can.
3 weeks.
Push it through. Somewhere in the 3-week range, right? If you pass all the underwriting and all the stuff works for you, you can usually get a traditional loan in a few weeks. If you find a lender who says, yeah, take that molded out wet basement house and take my money, fix it up, and then give it back to me in 6 months. If you tell them that, they're probably not going to really enjoy that deal either, right? Because why would I lend you money at 4.5% just to get it back in 6 months? Their deal is they want to package the stuff up, you're in it forever. They sell it on the mortgage-backed securities market, and that's what they do. So it might work, and there are obviously other institutions that are traditional lender types that have other programs, but it's not going to be really easily done with the good old-fashioned traditional Fannie Freddie stuff for timing reasons and for they just don't want to do it kind of reasons. So I think I've somewhat successfully bashed traditional lending. I don't know, representing what traditional lending, what am I not considering with traditional loan, or a more mainstream type of lender for loan products?
Yeah, I mean, so for everything that I do, I mean, most of this is, I would say, fairly accurate. So, you know, if you're going to a traditional bank and you hold the property in your personal name, then you got to deal with what we call a residential lender. However, if you hold it in a corporation like an LLC, then, you know, a commercial lender like me needs to get involved. So yes, most banks, you know, traditional conventional banks do require at least 25% of the total project costs. And however, like with our bank, we're a little different. We can actually go up to 80, sometimes 85% on it. And you know, we do have lines of credit out there for, like I said, experienced flippers, where once their line of credit is established, might take, you know, 3, 4, you know, depending on your own personal complexity, 5 weeks to get established. But once it is established, you know, you have a proven track record, then it's basically a guidance line of credit. Anyone's heard of that? You can go out, give us a purchase contract, we fund 100% of the purchase amount, and then you can go ahead and, you know, interest-only payments. Then at the end of that 6 months, hopefully you've sold it and paid back the principal. But yeah, I'd say yes.
So you mentioned track record. What else are you looking for to give, approve someone for that line of credit?
So, I mean, we do underwrite globally. So you're looking at the borrowing entity, and also the individual personally. It has to cash flow, debt service coverage ratio. The entity borrowing and the individuals that are behind it are personally guaranteeing it. All their income and all those debts have to cash flow globally. Hopefully at least 1.25 times. I can get a bunch of more details about how that is calculated. But yeah.
We love boring details, that's fun. But we'll come back to the 1.25. So, guidance line of credit though needs some level of gravitas on a resume to say, I've done this before, and you'll get your money back.
Like I've literally even gone out for some folks, I don't do it for everyone. I tell people, just create a simple chart of the stuff you've done over the last 2, 3, 4, 5 years. Purchase date, address of the property, how much you purchased it for. A lot of the stuff I can find. Right? If you give me the address, I can look up most of the stuff on county or Maryland or DC website. How much you sold it for. The only thing I don't know is how much money you put in, so you just need to tell me, and we can easily calculate, how profitable you were for each deal. So, as long as you're not, losing money or barely breaking even on every one of your deals, then okay, then that's a good resume, basically.
Would it be impacted if you use a different LLC for every property?
Possibly. So, we're only going to look at the LLCs that are going to be either borrowing or providing a corporate guarantee. If somebody has an LLC that's losing money hand over fist, but it's not part of the deal, then we don't think about it.
Yeah. And if you're using shelf LLCs to buy individual properties, one entity at a time, I guess you're suggesting probably a good idea if you had some other holding company somewhere that makes the money from this enterprise that you can say, okay, this is who's backing the deal, along with the personal guarantee of whoever owns that, right?
Exactly, and that's exactly what I'm doing now. Is I have a very experienced flipper, but the entity, you look at her income statement at the end of the year, then you look at the tax return. It's pretty big differences there. The income statement is probably more accurate. The income statement is probably more accurate than the tax return. So I told her, like, hey, why don't you just set up a new entity to do the flips? We're still going to look at you personally, and we make a lot of money personally. But yeah, so there's no past history financially for this new entity or this new LLC. But we do have that resume and track record where we can show people that, or my underwriters and chief credit officer, that yes, these people know what they're doing, they've been very successful, and they make a lot of money personally.
So give me a couple of months, working on a thing, really excited about it, for entity structuring and asset protection and that kind of thing that can get into things like holding companies in Wyoming and Nevada and Delaware LLCs and differences and why some of those might be better than others for anonymity and for asset protection. And it's information that we hope to be able to bring to everybody because that would help you establish those holding companies that let you have subsidiary LLCs that do the dangerous stuff. Safe company up here makes money. That's where you go to your lender and say, hey, I'm up here making money. These guys down here, don't worry about that. They don't exist. You can't find who owns them anyway. They're just there to do dangerous things. I do good things up here. But I hope to have that information, hopefully for everyone fairly soon. But back to our guidance line of credit. Once it's been established, what is the underwriting process for your deal once the guidance line exists?
Send me a purchase and sale agreement.
Okay.
And then in a couple of days we can, still we do a flood search on the property. If it's in a flood zone, you're going to have to get flood insurance, need hazard insurance on the property. We do an environmental search, which is almost instantaneous. So, and residential properties typically are not contaminated with any environmental concerns. So those never come back as hits or negative hits. But we send the money to the title company.
Okay. And about how long does that process take?
You can work about as fast as the title company.
Okay. Yeah. Title, depending on what somebody's last name is, can vary from a couple of days to a few days, but generally in the weekish time frame, if everybody's really hustling and everybody's really motivated, it can happen. We have very good friends who say that we buy houses in 7 days. And somebody used to say, like, I can close a house in like 48 hours. I've never seen it, but I don't know. Have you ever seen, what's the shortest time frame from
24 hours.
investor walks in the door, I've got a deal, I'd like to get it funded. I guess the title was done on that? That came with
I
title
would
work?
assume the title work was already done. I got the deal Wednesday night, we closed it Monday at 12.
Okay.
That was with, I mean, that's a very good title company, District Title.
Yeah.
So they know a lot of the ins and outs of the DC market. Typically what we're seeing right now, I mean, we're closing 60 a month, so we see a lot of the title companies. It's probably about a 14-day turn time.
Yeah.
To really get things back. Now they know when to push deals faster or not. So I would say, you know, budget 10,
Do we have
10, 14 days.
10, 14, yeah, on average.
Yep.
Do we have any title people here? Anybody used to be a title person, work for a title company? I was just curious what the worst, the last name to have is in title. It might be like Smith. Like if your seller is like Jerry Smith, like their title is like a million years, they had to find out if like this Jerry is related to that Jerry, and it's like 80 Jerry Smiths in every county in the country. And every once in a while, one of them has burnt somebody in real estate, so that loose end can be tied up. That can make your title take a minute. All right, but those are possible loan sources. We'll talk about the hard money loan process in a second and see how it's the same or different. Or maybe even now, private and hard money. Lenders, private individuals, right? Specialized companies who do this for a living, for fix and flip and rental investors. More expensive than traditional banks, maybe, but faster, more flexible. All right, so let's talk about the hard money process.
Can we talk about private first?
Sure.
Private, as from my sense, is an individual with a lot of money.
Yeah.
Maybe a competitor of a hard money lender because they could fund the entire deal for my client. However, I want them to have as many private money people as possible because they can fund your down payment as well. And that can be either a secured loan that's on title or it could not be. And the best way to do all of this is other people's money. So if you can get a loan from a hard money lender for first trust, making up 80% of the financing, go to your private money person and get that down payment so you're in at $0.
So you won't lend me 100% of
I will
all
not
the money I
lend,
need on a deal?
I will not lend 100%. I like to look at things that I will protect myself and protect you. However, if you want to go and get that down payment, I highly suggest doing that because I have a client who does 7 or 8 deals a year. All of it is raised money. Now they are paying on a higher percentage, however, they are done with deals in 3 to 4 months. You're paying 14% on $50K for 3 to 4 months. That is not a lot of money for what you're making on the back end of that. So the hard money side. We kind of got into it a little bit earlier.
And actually, I'm sorry, can we take questions while you're at it?
Yeah,
Before we forget? Go ahead.
Just, so you're saying like 80% would be the private lender and 20% would be the hard money?
Other way around.
20% would be the.
You wanna pay a higher interest rate on as little money as possible. Private money, individual people generally are going to have a 14 to, call it 18%.
So you're saying you go for the private money for the 20% down and the hard money for the 80%.
Difference. That's how you get into a deal 100% down.
Does that put you in second trust position?
I would be in first.
But then the 20% is the 20.
They're in second.
They would be in second.
Oh, they're in
They're giving it out,
And they're
they'll
in-
be second.
Yeah.
So, I mean, so you do allow the second deed of trust on your properties?
Yeah, I mean, we underwrite for it. Ideally, I would like it to be unsecured. Yeah.
Correct. So let's say, and so this is how you get into lending, by the way. Being the second trust, right? If you know somebody who's got a solid deal that you trust and you know that they're going to perform, they've got their 70, 75, maybe 80% LTV loan, but don't have the cash to get the rest of it done. This is a good deal. This deal's gonna make, you know, 100 grand. I do still need though another $40,000 to get it done because I've got my primary loan over here, but I still need the rest of the equity. You can provide that 40,000 or 20,000 or however much of it the investor needs at whatever terms you agree to, but of course those terms ought to be higher than what they might have paid for their first position loan because you are in a subsequent position, right? And position matters for lending, right? Because if things don't work out, who gets paid first? First position, right? And then if there's money left over, then we start going down the list of everybody after person in first position. But it is how most people start lending. Being a private lender to another investor who needs that remaining equity piece, that has a good deal, has a viable deal, but just needs a little bit of extra cash to get it across the finish line. And you should be able to command 15+% in this rate environment, at least on that money, right? And if the deal doesn't pencil out for that, well then don't do it, right? Wholesale it, do something else with it if it can't support what you would be providing as the second trust lender. But when everybody says, they go, oh, I've got my life, I'm thinking about lending, carefully, understanding all of the numbers, but approaching lending from that, I'll be your last cash into the deal scenario is a good way to get into lending. Just be careful, because you are not as secured as guy number one. You get wiped out if guy number one doesn't get paid back in full. Make sense?
It's from an investor standpoint, getting started, it's a really creative way to get in. If your own liquidity is not where you want it to be for the deal that you're looking at that time. There's a lot of money in this area. There's a lot of people who want to beat the bank. It is out there, so don't get discouraged trying to get into your first deal because you don't have the full down payment for whatever the lender is telling you need at that time. It's out there. You just have to go find it. It's all about networking in events like this, going to other grid events, even walking into job sites. Other investors also lend too for those positions.
Sure. You just have to make sure that it pencils out and that you can afford whatever interest you're paying to your second person, your private lender, who's providing the extra equity above your base loan, right? And then if it still makes sense after that, then you should do it. Do you get into that? Do you look at what your second trust lender is charging and what impact that has on the deal?
I do not look at what they're charging. I really just look at what the dollar amount is and what your liquidity is as an investor. I can't tell you the number of times where an investor has the liquidity for the down payment, closing costs, everything, but they're still getting a second trust to cover the down payment. That's my ideal scenario, where I know that you can cover it if all else fails. However, you're going to go raise that. That's on the borrower. That is on the investor. That's the way they're structuring their business. But we only look at what the loan to values and the loan to cost would be based on what you're getting for that second trust.
And so right now, someone on account
What's the up that you're looking for?
If you're going to be raising money and you're going to be 100%, I would ideally like you. This isn't a guideline or anything. This is my personal preference for a client. I want you to be at 60% LTV, ARV LTV, because in this market that we're in right now, if you're at 70, 75, we're going to start seeing some reductions in sales prices. You're now cutting into that second person's profit. Yeah.
Everybody understand what that means and what those numbers are. So you're talking 60, 65, 70% LTV of the after repair value, right? The house fixed up, on the market, sold to the new buyer. You're lending at somewhere 60 to maybe 80% of that number. So you get a screaming good deal. You're buying it at 50% of LTV, right? You've got plenty of equity there in your deal. Can I get 100% then?
Not for me.
Oh, still can't get the 100%. So, gonna require, what do we call it?
Skin in the game.
You gotta have skin, right? For your hard money lender. Even if you just stole this thing, you're gonna have to have some amount of cash in it from somewhere. Because without cash in it, or somebody that's gonna chase you down for that cash, you have no incentive to make sure that
It
your
puts you
project
in
is
line
going to
with us. It makes sure that we have aligned priorities with cash in the deal, because I can't tell you the number of times we've seen, or even where we've done a second trust for someone and given them 100%, but they walk away. Because in DC, I don't require PGs. I don't require personal guarantees. If there's no personal guarantees on it, you can just walk away if one thing goes wrong.
Why do you not require a personal guarantee?
Trade secrets, honestly.
Okay. Interesting. But a
That's
personal.
on, I will say that's on anything that's a residential.
Gotcha.
1 through 4.
You know, people walk away in DC.
Oh yeah,
You,
we have.
I think I got a
They
couple of
don't-
those listings.
they
That's
don't-
why I got 14 of those.
hit another slide. Let's see if that doesn't come up. What do we do when things go pear-shaped?
I can go into a little bit of the underwriting
Yeah,
for a hard money. So, a hard money loan is really, it's an asset-based loan. First and foremost, the property itself is what's most important. Secondary to that, and what's influenced based on leverage and interest rate, is gonna be the sponsor, the investor. What is their credit score, what is their experience? Those two things are what allow us to structure what our loan amounts are. An asset-based lender takes away who you are as an individual and just give me the numbers of the deal. Does this make sense? If it makes sense, I wanna find a way to make it work. Whether that's with you or you partnering up with another individual to make sure that you can get into the deal to leverage what you're looking for.
So you're pulling credit for all of your borrowers?
We do pull credit for all of our borrowers.
Uh-oh, watch out, I heard Pine doesn't pull credit. No credit, no problem?
We do.
Oh, sorry.
Just don't tell them.
We don't really care about their credit too much. We're primarily just concerned about any liens or judgments that could supersede us.
Okay.
Oh, I'm the other way. Mine's a 640 minimum, that's what we're looking for.
So what do you tell people that come in under 640?
Get a partner.
Get a partner,
Get a
right?
partner.
We have a
yeah.
question here.
You talked about experience, so as somebody who's never had hard money, what additional?
You have rentals though, don't you?
I do have rental.
Yeah,
I mean, I've talked to a couple of hard money and it's like, have you done any renovation, flips? And I said no. So he required a 25% down rather than 20. So
Are you trying to do a condo conversion? So really, experience is like in kind. I think there was another slide on there. Like in kind experience is the biggest thing in the lending world, at least in my opinion. Likely probably yours, but if you were doing single family rentals or from there, and then trying to go into a condo conversion, taking a single family home and turning it into multiple units, that's a little tough. That's tough to stomach as a lender, because are you able to do that? But single family to single family, that's like in kind, that's fine.
I'd say the bottom bullet point here is the most important point in lending. The cost of your loan is going to be based on the risk undertaken by the lender. If you've not got a ton of money, but you've got 800 credit and you're the kind of person who always pays everyone back, that goes into your favor. If you have stolen a house and bought it at 25% of market value, but you have a trail of unpaid people behind you, that will be reflected in your loan. If everything else is the same and you're just regular average Joe, but you only need to borrow 50% of the money, that gets reflected. If you need full 80% and you've got to bring in a partner with a second trust to bring in the remaining 20% of the cash that the deal needs, that is an increased risk even to the first lender, just because you're doing a little more scrambling, right? You're having to work a little harder to get the thing done. So just when you're approaching a lender, think like the lender. If I were going to be lending me money in this situation, am I going to be more or less of a risk than someone else with a different credit background, looking for a different loan amount, who's done this maybe a different number of times, more or less than me? And if you think you might look better than somebody else, make sure your lender knows that too. Oh yeah, I've done this before. Did you check out my credit report? I've never stiffed the paper man in my entire life. This stuff matters. None of it matters wholly. There aren't too many things that absolutely make a really good deal unfundable. We'll find a way to fund it, right? But it's all about the risk. The cost of your loan will be based on the risk that you're asking your lender to take from a leverage standpoint, from your credit standpoint, from an experience standpoint. So they're not really like hard and fast numbers that everything always goes down this way. It's all baked in, right? It's all a little ingredient in the pie.
Number one thing is relationships, honestly. I have a client with a sub 600 credit score that I've done 13 deals with.
Are they making money?
He pays me every single time. I know he pays me, he might not pay others, but he pays me.
Have you ever talked to anybody out of it?
All the time. I talk to people out of deals all the time. I might not be the best sales guy for that, but I don't want to put my clients into something that I want to do personally, especially starting out early on. For me, I think the most important deals are your first 3 deals. It's where you're learning your systems. It's where you're setting up your processes, where you're doing, you're learning on the job. No matter how many courses you take, there's nothing like actually doing the deal. Those first 3 deals are so important because they set you up for success over the scalability of your business, and they build upon your war chest of using your own capital to get into deals. So I can't tell you the number of times in the first 3 deals that I'm saying, no, we're not doing this, here's why. Because they may come to me with an ARV of 400, but when I underwrite that deal, I'm looking at 350, and that drastically changes their ROI. If there is too big of a gap and I'm not comfortable with it, and we have a good enough relationship where they're agreeing with me, we can find another deal that fits for them.
And remember, go ahead.
Just a quick question on the credit score thing. If you have someone below the minimum, 640, but then someone else is above the minimum, how do you kind of balance that out? Is it just
I
like
use
take
the highest
averages? And, okay, so the other person,
Assuming
I
they
guess, and then
become
the other
50/50
person, you always
members.
kind of forget about the one with the low score.
Mhm.
Okay.
Assuming they become 50/50 members on an entity, I'll use the highest score.
What's the opposite of a traditional lender? Traditional lender, you've got people
Hard money.
with the lower score.
Yep. And
Again,
that
the
conservatism.
deal is important.
That conservatism is reflected in the fact that they are lending 90, 95, 103%, and they expect you to be there and paying on it for 30 years. These loans are hopefully being paid back in 6 months, maybe less, sometimes more, depending on the size of your deal, right? So the metrics are different. It's what is your likelihood of success and what is my risk over the next 6 months while your project is happening. And so back to people not getting funded. Rule number 1, if your hard money lender says I wouldn't do this deal, maybe at least talk to somebody else about it first, and not just another lender and go knock it until somebody will give you the money. You only make money if you can make a loan, right?
I don't have a salary.
So if your lender is telling you not to do it, there may be a reason, right? Lenders can be good sounding boards, not to call for everything that you might be looking to do, right? I'm assuming you would prefer that people actually have their deal.
I get
maybe
called
in
for a
under
lot
contract.
personally, but I've been here for a while.
Try not to call for everything you might possibly be looking at. But when you do come in and your lender tells you, this really doesn't make much sense for you, you probably ought to think twice about it.
I think as an investor, you have to be very realistic on your exit numbers. I have a deal right now where the investor, so when you're looking at a house, price of the home matters in relation to the location, seasonality, and condition, right? You're gonna improve it, you're gonna have great condition, you gotta get seasonality right, but you also gotta get location right, and I don't mean the city, the zip code. A lot of investors, I saw 3 investors make this mistake this year, being next to a road, being next to a school, makes a difference backing into private area versus not, makes a difference in the price. So I had an investor who on paper is like, this is what, ARV is 1.2. We're on the contract for 850 because they got the location wrong. Now, market shifted on them. They had an offer for close to $1 million, but let's say they were on the contract for $1 million. That's $200,000 miscalculation. And when I saw the deal, because they were with another agent and they're like, it's not selling, I'm like, this is $1 million. First offer was $998, and they didn't want to accept that, right? Now they're redeeming themselves for a different price. So,
Also bad
these are, say that again?
Also bad neighbors sometimes.
Sure.
Yeah,
bad neighbors.
oh, absolutely.
Where do you make your money?
Say again?
Where do you make your money?
Wrong banks.
When you buy it.
Yep, when you buy it. So that's the number 1 thing to look for as well, and that relates to exactly what you just said about location, seasonality, all of those.
You cannot build your way out of a bad neighborhood. You cannot build your way out of a bad neighbor. You cannot build your way out of a bad market. So, yeah, you should be making the money when you buy the house. What else we got? Okay, so here's a good point. So with properly structured loan, your return on cash is higher than when you just use your own cash and when you use a partner, right? That is because of a beautiful thing called leverage, right? Using someone else's money means I get to make more with mine. So all other things being equal, you do a deal that, let's say, it takes $500,000 to do the whole thing, buy it, fix it up, get it ready to sell, right? And it's gonna make $50,000 at the end of it, right? So roughly 10% of the ARV. If I do all of it in cash, $500,000 out of my bank account, do the deal, make my 50, I made 10%. Let's say it takes a year, right? An even, nice 10% return on my money. However, if I borrow, and I might need somebody else doing some quick math, but I don't know what the 80% plus some other stuff would be, but what's 80% of 500,000? Smart people. 400? I'll take your word for it. 400,000.
I can do 3% of anything too.
400,000. Yeah, I'll bet you can. 400,000. I get an 80% loan for $400,000 to do my deal. Now I only need $100,000 to do the deal. But my loan's going to cost me a couple of bucks, and let's say my loan costs me $20,000 for the $400,000 loan. 50 minus 20 is 30. Only $30,000. I could have made 50 if I spent all my own cash to do it. But if I had done it in my own cash, that $50,000 would have represented a 10% return. I only needed $100,000, and I made 30 at the end of it, even after paying for my loan. What's 30% of $100,000?
30%.
What's 30,000 on a $100,000 investment?
30%.
I cheated. I gave the answer 30.